Hello, Marc Ostwald from ADM Investor Services International, with some thoughts on the forecasts that we've had this week from the OECD, and above all, what seemed to impact markets most, the rather gloomy forecasts from the Fed. I'm not going to go into the specific details of the Fed's economic forecasts, but I'm going to start rather off with the OECD economic forecasts. They outline two scenarios, as one can see in the table. The bulk of them basically highlight a couple of factors. One, the recovery is not expected to be particularly strong in 2021, recovering roughly as a half to three quarters, depending on which country it is. It's very noticeable that France, Italy, and the UK are seen as the big laggards, and under a double hit scenario, which is basically implying that we get a second big round of the coronavirus infections, the hit will be even bigger, and the recovery in 2021 will be that much weaker as a result, because it's effectively delayed, and there will be an even bigger economic shock to consumer spending. Be that as it may, shortly following the OECD's forecasts, we also had the Fed's forecasts, and I've got the dot plot from that. I think the key aspect of the dot plot is basically they're not looking to hike rates anytime before the end of 2022. And sadly, obviously, that sends a very negative message in itself, because it assumes that we'll need the sort of super low levels of interest rates that we've got for at least 3 years, which doesn't exactly imply a vigorous economic recovery. Unsurprisingly, markets took some umbrage at that. So exactly how overvalued have markets got themselves? Well, I've got two particular charts relating to the S&P 500. The first one is PE valuations, price earnings valuations of the S&P 500 over the past 20 years. And we are now at a multiple of around 22. And I think the important aspect of this is how it compares to us being getting close to a similar peak and above the prior peak in 2007, but to a similar peak at the time of the dot-com bubble bursting. The fourth chart is pretty much the same sort of message, and that's the percentage of S&P 500 stocks that were trading above their 50-day moving average. And as one can see, that was getting to around about the 90% mark, which basically tells us about positional skew in financial markets. And that's an important aspect, because when you start to have a bit of a correction in a market which may have a lot of central bank liquidity, but doesn't necessarily have a lot of market liquidity, i.e. depth, to the market, good bid and offer spreads, then it can exacerbate moves, as we saw yesterday, as we saw on Thursday, with the very sharp downturns that we saw in the Dow, S&P, and the Nasdaq. Whether that continues, I'm not really quite sure, but what's for sure is a spike in volatility is something I've been looking for quite some time. Is this just a correction, or are we going to get constant reminders about how bad things are? Well, my final two charts for today, first of all, to exemplify the degree of madness that we had in financial markets ahead of that sell-off, and that is the Hertz share price. Hertz is a company which has declared bankruptcy, and yet we managed to go from May the 26th valuation of just 40 cents to a June 8th valuation of $6.28. Really quite astounding to see a more than 1,000% increase in a share price of an equity which is effectively bankrupt. My final chart is from the NACM, and it shows their monthly reports on receivables in arrears versus bankruptcies. And really what this chart is telling us is that the receivables chart has collapsed. So there are a lot of arrears, and the bankruptcies chart is basically a lag to that. So basically, we are going to have a problem with insolvencies as we go forward, and this will continue to buffet equity markets. Those are the thoughts for this week.